So, back in December of 2025, the Federal Reserve did something, well, kind of weird. They cut interest rates. But at the exact same time, they told us they expected the economy to be stronger in the year ahead. Now, that sounds like a contradiction, right? But it's not. It actually signals a huge pivot at the most powerful central bank in the world, and we're going to break down exactly what's going on. So that's the big question we're tackling. How can both of these things be true at the same time? What is the Fed seeing that maybe the rest of us are missing? And trust me, this isn't just some abstract economic debate. The answer directly affects everything from the job market to inflation and, yeah, your wallet. All right, here's how we're going to unpack this whole thing. First, we'll look at the surprise decision itself. Then, we'll dig into that optimistic forecast that seems to fly in the face of it. After that, we'll uncover a massive kind of under-the-radar policy U-turn, and that will lead us to the real reason for this whole pivot. Finally, we'll check out the Fed's own map for the future and tell you what you need to be watching for. Okay, first things first, let's get right into the headline news from that December meeting. So the main event was this. The Fed cut its key interest rate by 0.25%. Now, this was the third time they'd done this in just a few months. The idea was to get rates into what they call a neutral range. That sweet spot where they aren't slamming the brakes on the economy, but they're not flooring the gas pedal either. But here's the thing. This decision was anything but a sure thing. Sure, 9 members voted for the cut, but 2 wanted to hold steady, and 1 person actually wanted an even bigger cut. It just goes to show how tense and complicated things are right now. As Chair Powell put it, this division really highlights the tug-of-war the Fed is always in, trying to keep prices stable while also making sure people have jobs. And this is where we get to the real head-scratcher. In the very same meeting where they decided to cut rates, the Fed's own forecast for the economy actually got better. You can see it right here in their own numbers. They seriously bumped up their projection for economic growth in 2026, and at the same time, they predicted that inflation would actually take down a bit. So let that sink in. They're expecting stronger growth with less inflation. I mean, how is that even possible? Well, lucky for us, Chair Powell basically spelled it out. The magic word is productivity. The Fed thinks our economy can now grow faster without kicking off a ton of inflation, and a big reason is that we're getting more efficient. He even name-dropped AI as a possible factor, saying it allows companies to produce more without necessarily hiring more people. And if you don't need to hire as many people, that keeps wage growth in check, which helps keep a lid on inflation. But honestly, the rate cut wasn't even the whole story. Something huge and way less talked about was also going on with the Fed's balance sheet. The whiplash on this is just stunning. I mean, think about it. Just back in October, the Fed was talking about stopping the process of shrinking its giant portfolio of bonds. That's a process called quantitative tightening, and it pulls money out of the financial system. Okay, now fast forward just 2 months to December, and they slam it in reverse. They're not just stopping the shrinkage. They're starting to buy $40 billion in new bonds every single month. That is a wild pivot. And to put a number on it, because it's a big one, going from letting about $30 billion in bonds just fade away each month to actively buying $40 billion, that's a $70 billion swing in cash being pumped into the financial system every month. That is a massive injection of liquidity, arguably a much bigger deal, dollar for dollar, than the rate cut itself. Now, of course, the Fed is really careful with its language here. They're calling these reserve management purchases. They're insisting this is just a technical plumbing issue to make sure banks have enough cash on hand to operate smoothly. They're saying this is not stimulus. It's not like the quantitative easing from back in the day. But look, call it whatever you want, the effect is the same. More money sloshing around in the markets. Okay, so we've got a rate cut, a forecast for stronger growth, and this massive cash injection. So what's the one big idea that ties all these threads together? It all comes down to a fundamental shift in what the Fed now sees as the #1 risk to the economy. And boom, here it is, right from their official statement. They say, for the first time, that the downside risks to employment rose in recent months. This is the whole ballgame right here. The Fed has officially shifted its attention from putting out the inflation fire to making sure a fire doesn't start in the job market. You can think of it as a balancing act. For the last year or so, inflation was the clear and present danger. That's all they were focused on. But now, the risk that the labor market could weaken has jumped to the top of their worry list. The balance of risks has officially tipped, and so has their policy. And if you're wondering why they're so worried, Here's the kicker. During his press conference, Chair Powell let it slip that the Fed's internal models suggest the official government job numbers are wrong, that they're overstated by about 60,000 jobs a month. So if you see a headline that says the economy added, say, 40,000 jobs, the Fed looks at that and thinks we actually lost 20,000 jobs. They're not reacting to the past, they're acting on the weakness they think is already here.
Okay, so they pivoted to protect jobs. But does that mean we're about to see a whole series of rate cuts? Well, to figure that out, we have to look at their own internal forecast, the famous dot plot.
And this is where we get yet another surprise. The median projection, so the middle-of-the-road guess for where interest rates will be over the next few years, and in the long run, didn't move at all. Even though they just cut rates, their long-term game plan is exactly the same as it was before. So what does that tell us? Well, in Chair Powell's own words, the Fed feels they are now well-positioned to wait and see. This whole pivot wasn't about kicking off a long cycle of rate cuts. It was more like an insurance policy. They wanted to get rates to a neutral spot fast, and then just pause, hit the brakes, and see what happens with the economy. They've given themselves a cushion, and now they're going to sit back and watch. All right, so that's the full story of the Fed's big December pivot. It was a preemptive strike, right, driven by this growing fear about the job market. And it was only possible because they believe the economy can grow faster without stoking inflation. So what happens now? What should you be looking for? Well, the Fed has pretty much given us their checklist. They are going to be glued to those monthly jobs reports to see if their fears about a weakening market actually come true. They'll be watching every little tick in inflation data, trying to separate the real trends from the noise. And of course, they'll be keeping a close eye on consumer spending, wage growth, and anything happening around the world that could throw a wrench in the works. These are the things that will dictate their next big move. And that really brings us to the final lingering question. The Fed has gone through this complex maneuver just to put itself in a position to wait. But remember, they only did it because they see big risks on the horizon, and they believe the data we're all looking at is already out of date. In an economy that's changing so fast, thanks to things like AI and global tensions, maybe the biggest risk of all is thinking you actually have time to wait and see.